Moving away from content that is inherently extremely macroeconomic in nature, let's talk about something that hits home on both a micro and macro level. Paying for stuff, payment methods, thinking about how people buy stuff, okay? As it turns out, payment methods, the method by which people make payments, is an evolving thing. If you go back about 50 or 60 years ago, people were using cash, people were using checks a bit. Nowadays, as we know, everything's becoming more and more automated, more and more digital, okay? So in fact, 38% of payments are made by credit cards as of the most recent source of data that I could find. And so that's the most common form of payment. Next on that list, with about 29%, is debit cards. And I probably don't need to define these, but just in case you don't really understand the difference between these two, in the case of credit cards, the spender is the borrower. So when you buy something using a credit card, you're actually borrowing the money for that purchase. All right? On the other hand, if you're using a debit card, you're really just withdrawing from an account. Obviously, it's more complicated than that. The money is not instantaneously taken out of your account, but that's essentially what's happening, okay? So if you add those up, what that tells you is about 2/3 of all purchases are being made by credit cards or debit cards, okay? There's also something called a charge card. A charge card makes up about 5% of purchases. Charge card is like a credit card with a couple of key differences. When you use a charge card, there's usually no spending limit, but you have to make all of your payments in full. So you're borrowing money for like a month period, but you have to pay it all back at the end of the month. So it's a little bit different. Also, things like digital wallets make up about 10% of purchases. And so what that tells you is a small proportion nowadays are actually using cash. So cash only makes up about 12% of purchases. And these cash purchases tend to be relatively small as well. In other words, when people are using cash, they're usually buying stuff that is cheap, right? They're not going out and buying cars with cash, for example. Okay, so since so much of purchasing are made by credit and debit cards, it makes sense that we spend some time talking about how these work. So let's start with credit card transactions. I would say chances are if you're watching this video, you're like me. You typically use a credit card or perhaps a debit card when you're making your purchases. But from the consumer standpoint, there's not a whole lot of reason to really pay attention to what happens after you make that purchase. In other words, if I'm using cash and I'm buying a meal, that meal will be $8 if I'm using cash, or it will be $8 if I'm using a credit card. However, if you're the restaurant, if you're the merchant, the difference between a person using cash or credit card is actually really important to your bottom line. And that's because credit cards carry fees. Fees that are taken out of the purchase amount, all right? So there are actually a few different types of fees. We could label these all together kind of as like a headline title. We could call these processing fees. And this is the percent taken out of a transaction. So if you're a restaurant and you sell something for $8, you're not going to get $8 if the consumer is using a credit card. You're going to receive less than that. And we can actually break this down into 3 types of fees. Okay? So processing fees just refers to the fee that credit cards charge in totality. But in reality, the fees are not all given just to one entity. The fees are broken up into 3 sections. In other words, 3 entities profit off of credit card purchases. One of those fees, to be specific, is called an interchange fee. And this is the largest of the fees. And this is a fee charged by the bank that issues the card. And it makes sense that there would be fees. All right, just to be clear, fees are reasonable in this case. It's a big deal. It's a big transaction. It's risk. If you're issuing a credit card, the bank that is paying for the item is basically loaning the spender money. So it makes sense that the bank would charge a fee, okay? What's unique in this case, though, is the fee is not being charged to the customer. It's being charged to the merchant, to the one that's actually receiving the payment, okay? And so when I say this is the fee charged by the bank, this could be, for example, Chase, Wells Fargo, Bank of America, companies like that. So if you have a credit card, the largest credit card organization bank is Chase. So if you have a Chase credit card, Chase is essentially lending the money so that the purchaser can make that purchase. And they're going to charge the merchant, the business that's making the sale, a fee, okay? So that could be Chase, could be Wells Fargo, could be Bank of America, and the list goes on and on. Lots of banks offer these types of credit cards, right? And the exact size of these fees can vary, but this is the largest portion of the overall processing fee. Okay? And so that's more than half of the overall fee that's being charged is the interchange fee. Two more types of fees. The second one is called the assessment fee. And this is the fee that's charged by the payment network. Okay? The fee that's charged by the payment network. So if you have a credit card or a debit card right now, pull it out and look at it. You're going to see a couple different things there. One thing you're going to see is the name of the bank, something like Chase or Wells Fargo. And then a second thing, you're going to see a little logo for a company like Visa. All right, and that's who we're referring to here. So this might be like Visa, American Express, something like that. Okay? Could be Discover. Discover is interesting because they basically handle both of these. They're kind of like a bank and they're kind of like a processor for these payments. Okay? So you got an interchange fee charged by the bank, and then you've got an assessment fee charged by these companies like Visa or Amex. So basically they're facilitating these transactions. They're actually providing the system through which all these purchases happen. Okay? So when you swipe your credit card, it's like the money's coming out of a bank. And then you also pay a fee to this company that is basically organizing this worldwide system of payments that's occurring. Okay? On top of that, finally, you have the payment processing fee. And this is basically a fee that the business, such as the restaurant, pays to the entity that is procuring these transactions. If this is confusing to you, if you're trying to kind of think about the difference between number 2 and number 3, this is fees charged by the payment network. This is fees that the business pays to the entity that is procuring these transactions. Those sound pretty similar. Here's what you kind of need to think about, okay? If you go into a restaurant and you make a purchase, when you slide your card, that thing you slide your card in is the payment processor, effectively, okay? That's not going to be a Visa card swiper or an American Express card swiper. It's going to have some other name on it, okay? And that is the payment processing side of the fee, okay? The interchange fees, really non-negotiable. So if you have a company, you're not going to be able to negotiate with Chase for them to change their fees unless you're massive, then maybe you have some power. But let's say you're starting a restaurant, there's no negotiation here, okay? You have to deal with these companies. Same deal here, the assessment fees, you have to deal with these companies. You can choose not to accept it. For example, some businesses don't accept American Express. You can choose to do that, but you're going to lose some customers if you do that. It's the third one here where you have the ability for a little bit of wiggle room. So there are many different payment processors out there that have different ways of setting up payments, okay? In some cases, you might pay a membership fee. So you might pay $500 a month to have a payment processor, and that's your entire fee. Or you might pay a percent, 0.5% for every single transaction. So there's many different ways that these can be set up. But this is where you have some wiggle room. This is where you can do some negotiation. These are like national standards that you're not going to be able to change, okay? So if you add up these three fees, the expense can be quite large. This varies significantly. It varies on a month-to-month basis. It varies based on the type of business that you have. So these companies like Chase, Bank of America, and so forth, they actually charge different fees to different types of businesses. So if you're a charity, they charge one fee. If you're a restaurant, they charge another. I don't know exactly how they land on these choices, but there are different industry codes, basically, to determine what amount you're actually going to pay. If you add it all the way up, the minimum fee that you might expect to see, including all three of those individual fees we just talked about, is about 1.29% for the entirety of the charge, plus 5 cents. Okay, and this is what you're going to normally see. Most of these transactions occur with a set price plus a percent that's a proportion of the overall payment amount. Okay, part of the logic of this is that if you didn't have a little fee here, well then, let's say somebody went in and bought a stick of gum for 4 cents. 1% of 4 cents, there's really no way to do that, right? So there's a flat amount to guarantee that there's at least 5 cents is going to go to the entities that are providing these payments, okay? Fees can be bigger than that, though. That's basically the minimum of what you might expect to see. For some companies, you might see much larger, depending on your industry, depending on the type of bank that you're dealing with. Could look as big as that, 3.45% per transaction plus a dime. And just to give you an example of one specific type of card system that you actually see quite a lot. There's nothing particularly unique or fancy about it, but Square is something you probably have dealt with before, maybe even have a little Square card swiper. I see this a lot of times if I go to like farmers markets or something, right, where it's just connected to people's phones. It's very convenient. A lot of times small businesses like Blackbird, for example, uses Square. It works pretty well for smaller companies that have a lot of small transactions like coffee shops. Their fees, to give you a specific amount, is 2.6% plus 10 cents, just to give you one example. And sometimes different companies will have different added on fees or negotiated parts. You're going to be working with, again, a bank, and then a company like Visa, and then a company to process the payments. Those three unique fees. What's different about Square is they have a flat fee for basically everybody. So if you charge your friend for a purchase, it's going to be this amount. If you open up a business using Square, it's going to be this amount. So it standardizes everything, and there's no like monthly payments you have to make or anything. It's just this per every transaction, okay? So just to give you an illustration of what this kind of looks like, if I go into a company and I buy a coffee for $2.08, what that means is that the fee, if you do the math, would come out to 15 cents. Okay, so you guys do the math. Make sure you can match it. 2.6% of $2.08 plus 10 cents comes out to 15 cents. Make sure you can do the math on that. It's easy math though, right? And by the way, I'm rounding this totally on purpose in this case because that's how they do it. So they round to the nearest penny after the transaction is made. Okay, so if I go to Blackbird Coffee and I buy a small coffee, the total comes out to $2.08. The fee is 15 cents, okay? By the way, they do charge a fee even on the taxes, all right? So the fee there would be 15 cents. So the revenues, if I just take $2.08 and subtract off 15, comes out to $1.93, which is pretty substantial, right? If you think about the fact that lots of people are making small purchases like this, that 15 cents can add up substantially over the course of a month or a year or the career of a business, okay? To give us a feel for what that fee really looks like relative to their revenues, I'm going to add this little term here, the effective fee in percentage terms, all right? And the effective fee is simply going to be the fee divided by the price of the item times 100 to turn it into a percent. And this is not like some industry term or something that you're going to see in other classes. No, it's really something I'm just making up to help us get a better feel for the way this works. All right, it's just saying what percent of the purchase went to the credit card related companies. Okay, so in this case, if you do the math and you take the 15 cents and you divide it by the purchase price of $2.08, what you'll see is the overall fee as a percent of the purchase price is 7.21%. And you can see why that is a big deal. If you're a company like Blackbird that's doing a lot of small purchases like this, it would be a big deal if 7.2% of your purchases are going to the credit card companies and related affiliates like the banks, right? And there's really not a whole lot you can do about it, all right? You can ask people to pay with cash, but then you're choking out some of your market, right? A lot of people don't want to carry cash around. They want to use credit cards. So if you say we're only going to accept cash, you're going to lose some customers. You might give people a discount for using cash, but that can be confusing. That can also be alienating. People who use credit cards can feel like they're getting gypped, right? Because giving people a discount for using cash is really the same thing as telling people to pay a premium if they use a card, right? You're segmenting the market, you're price discriminating. A lot of people don't like that, all right? So there are ways to deal with this, but there's no easy solution. And furthermore, as we'll learn later on, customers like using credit cards. Credit cards give perks back to the customer. So if you only accept cash, you're going to have some customers that decide to go to a different coffee shop instead. So generally speaking, this is just part of the cost of doing business for companies like Blackbird Coffee. Just to show you how transactions change as the size of the transaction grows, let's do a second example here. Still using Square. Second example, let's imagine that you go to Blackbird and instead of just buying a coffee, you buy a shirt, you buy a coffee mug, you buy some sort of expensive latte, and so you have a total purchase amount of $63.18. Okay? So we're going to apply the same calculation here. And you can see, by the way, that this 10 cents, that's constant. So as the transaction grows, the percent of the effective fee shrinks. All right? You'll see that right now. If the purchase is $63.18, what you will find is the fee is $1.74. So the bigger the purchase, the bigger the fee in dollar terms. Okay? But the bigger the purchase, the smaller the fee in percentage terms. All right? So doing more transactions, doing higher value transactions means that a smaller percent of your revenues will go to these credit card companies and their affiliates. All right? So the total revenues on this one is $61.44. And if you solve for the effective fee in percentage terms, like we just did, what you'll see is the effective fee is 2.75%. Okay? So again, this shows you that if you're a business that does lots of small transactions, the fees are going to hurt you more when you think about the effect of the overall revenue. All right? A business that does transactions at this level can expect about 2 or 3% of their money to go to the credit card companies, versus a small company that's making small purchases like we did with the first example might see like 7% of their revenues going to credit card companies, which is a big difference. And by the way, that is a reason why, if you've ever wondered, credit card companies or businesses will often have like a minimum purchase amount. So they'll say to use a credit card, you have to spend at least $10. Part of the reason they do that is because they're going to get eaten alive by fees if people go in there and buy a stick of gum with a credit card. All right. Another reason why they're doing that is they're hoping you'll spend more money to hit that $10 limit, okay? So that's how credit cards work. Okay, so we ran through that real quick with credit cards. Let's talk about debit cards really quickly. They are similar, but not the same. When it comes to debit card, there are two options, and you may have noticed this with your own transactions. I don't use debit cards anymore, so this is not something that I see. But I know that when I used to use debit cards a lot, like college students tend to do, college students use debit cards more than like any other portion of the population. You'll often get asked if you want to provide your signature or use a PIN transaction. So I remember like when I was in college, they would be like, is this credit or debit? And I would hand them the card. I'm like, well, this is clearly debit. But they would still ask, is it credit or debit? What they're really asking is, do you want to sign for this transaction like you would if it was a credit card? Or do you want to enter your PIN information? So sometimes you're going to get this option. Sometimes they're just going to choose one for you and put it back. I've noticed that during COVID, it's a lot of just sliding, giving your card back. You don't even have to sign, okay? So what's unique, though, is the way these fees are calculated tend to be very different, okay? When you sign, this is basically treated like a credit card. And the processing that takes place is just like a credit card. You got those 3 fees. It's just like a credit card. Basically, if you sign for it, it's like they pretend it really is a credit card when they're processing those fees. But if you use a PIN, that changes the way this is processed, okay? If you use a PIN, that's going to change the fees. It's going to change the way it's processed. And what you're going to see is the fees end up looking like 5 cents, 0.05% plus 25 cents for a debit card purchase. Now, is this going to be better for the merchant to use this type of method? Or is it going to be better for them to use the credit card? Well, it depends, okay? You can see that this quarter upfront cost that you have there, if you're using a really small transaction, like we did with the Blackbird example, if you're buying a $2 cup of coffee, this is going to be a really bad deal. But if you're buying like a $30,000 car, and let's say you can do that with your debit card, which is possible, well, then the fee is going to be relatively small in percentage terms. So if you're a company and you're facilitating these types of transactions, ideally, you would like to be strategic. And I've noticed that companies tend to not be all that strategic when it comes to these types of transactions. If I was running a business, I would have a little dollar amount. I don't know what that amount is. I'm going to ask you guys to solve for it for the exam. But maybe $16.15 is like the cutoff price, where if your transaction is smaller than this, you should use credit. But if it's greater than that, you should use debit. You can squeeze out a few extra cents of transactions if you set it up like that. So that just goes to show that debit and credit are treated differently. And the reason is, when you use a debit card, you're not really borrowing. That money is coming out of your account. So it doesn't have to be treated the same. But if you sign for it as if it were a credit card, they do treat it like it was a credit card, even though it's not. So now let's talk about how banks, and banks in particular, profit off of credit cards. We already saw one way that they do this, and that's through interchange fees. There's also those fees that go out to like Visa, for example, and American Express. Those are the assessment fees, right? But I don't want you guys to get too mucked up and trying to figure out who's getting what, okay? I want to really think about this from like the business perspective and think about how consumers respond to this, okay? So if we think about just banks for now, they're the ones who charge the largest fee. The majority of those fees that we've been talking about are the interchange fees, okay? So that might be like 1.5% plus 10 cents per transaction. It's going to be the bulk of the overall processing fees that occur for credit card. So that's one way they make a profit, but that is not the only way they make a profit. They also make profits off of late fees. So if you are late in making your payments, they're going to assess you a fee. That might be something like $40 for making a late fee in any given month on your credit card. You also will be charged interest if you don't make your payment. Okay, essentially, when you look at your credit card statement, if you've never had a credit card, you're going to see a couple of different options. You're going to see your statement balance. and you're going to see your total or outstanding balance. And you'll look at them and you'll see a couple of different figures. Might look like this. And a lot of people don't understand what they're looking at when they see this. And so what will catch their eye is this minimum fee, and that'll be like $68 or something. And the mistake people will make is they'll pay just the minimum fee, thinking, well, paying the minimum is smart because then I don't have to pay all the rest of it. But if you pay the minimum fee, you avoid like little fees. You avoid fees like late fees, for example, but you still have to pay interest. And these companies charge big interest rates. You know, they could be between 15 and 30% in a lot of cases. Occasionally you'll find credit cards that offer no interest for a while, but these companies that are making money off of interest are intentionally targeting people that they think are unlikely to make payments, okay? And they're going to charge them with high fees. So if you need to borrow some money, credit cards are a terrible way to do it because the interest rates are so high. So thinking about these three values you see, the minimum fee shows how the minimum you can pay to avoid like late fees and such, but you still have to pay interest, okay? If you pay the outstanding balance, you're paying off the entirety of the card, which is not really necessary. If you want to just avoid all fees and all interest, you could just pay the statement balance, okay? The logic of this is that your charges for a given period all fall into your one monthly payments, okay? So for example, between April 3rd and May 3rd, you might have $613.84 in transactions. And come June 1st, you have to pay all of that off to avoid getting charged any fees or any interest. But if you pay off the entirety of it, you're also paying off transactions that happen after May 3rd, which are technically in your next payment cycle, okay? So a lot of times, it's actually smartest not to pay the full amount, but just to pay the statement balance. And the benefit is, if you just pay the statement balance, that frees up about $1,500 that you could then go, for example, invest in stocks or bonds to earn interest on, right? Take that $1,500 extra, invest it, turn it into $1,510. Now you got $10 there in extra profit, okay? That's called a payment float, if you're curious. So, banks make money off of interchange fees, late fees, and also all that interest that they charge to customers. There's one more primary way that credit card companies make money off of you. They sell your information. So when you're making transactions using your Chase Visa card, for example, a lot of times they're going to take all those purchases you've been making and they're going to sell that off to various marketing firms. When you sign your paperwork, you put your name and your address and stuff, a lot of that's going to usually be sold out to advertising firms. So companies make profits off of that as well, okay? So taking all of that in, let's think about how banks feel about individual consumers. And let's take me, for example, okay? In a given month, my family, it's me, my wife, and 2 kids, we might spend around like $4,000 a month on our credit card, right? And of that $4,000 a month, let's think about how that feels for the credit card company. For that $4,000 a month, we can scale that up and recognize that that's about $48,000 a year, okay? Right? $48,000 a year or so. And on average, if we think about the way fees are set up, this is going to be basically going to generate 3% in fees. Some purchases that are small, like that coffee purchase, you might pay 7, 8% for going to the credit card company. Larger purchases, it might only be about 2% going to the company, depending on the type of credit card processor and everything that you're using. But the bottom line is, the credit card company makes money off of me, right? If I stop using the credit card, they don't generate those fees anymore. So let's take 3% of $48,000. If I'm doing the math right, I believe that's $1,440. Hope I'm doing the math right there. Okay? So basically what that means is that's, in a way, like free money for the credit card company. Once they already have everything set up, that's free money. Now, they're not charging me any late fees because I'm always going to make my payments. They're not going to be charging me any interest. But they're generating $1,440 off of me. Well, let's think about it then. Okay? If I am this profitable for these companies, then you can imagine various companies out there like Chase, Wells Fargo, Discover, and so forth. They would all like a piece of this action. Okay? So there's an incentive to lure me to use their cards. All right? They could just pay me. They could pay me $500 to use the card, but that doesn't really work. Because if they just pay me to use the card, I could just take the money and then just not use the credit card, right? So what they need to do is figure out a way to incentivize me to use their card. Not only to get their card, but also to use it. And this is where rewards comes into play. All of these companies I'm talking about here offer massive rewards. Because let's face it, if Discover has to give me $1,430 in rewards, they're still generating a $10 profit off of me. So they're willing to spend up to that amount so that they can secure my business instead of someone else. So there's a lot of money that gets kicked back to the customers, and that's what we're going to talk about next.